Well, it's 2025, and if you're looking to buy or sell a home in California this year, you might be wondering what's going to happen in the California real estate market in 2025. And that's exactly the question we'll be answering in this video as we take a look at the 2025 California housing market forecast from the California Association of Realtors. My name is John Schwartz. I'm California's 1% homebuyer agent. If you're looking to buy a home in California and want to get everything you need from an agent while paying a whole lot less, you can learn more at my website, jonsch.com. That's JONSCH.com. Now let's get into the forecast. So we are looking at the 2025 economic and housing market forecast created by the California Association of Realtors. And it's important to keep in mind that the California Association of Realtors serves a couple purposes. One, it creates the legal paperwork that we California realtors use to buy and sell houses. The California Association of Realtors also collects the best data on the California housing market because it is tapped in directly to all of the local MLSs throughout California. However, the California Association of Realtors is also a lobbying group. It exists to promote realtors and their livelihoods. So some of the data in this report I feel is a little biased, and where appropriate, I'm going to skip slides that are just constituted of puffy material that realtors can use to convince buyers to buy or sell in 2025, as well as point out items on slides that I think are kind of biased bullshit. So let's get into it. All right, and we start with the big prognosis that the California housing market is off life support, but there's a long road to recovery. Now, why is this? Well, the acute issues have been triaged. CAR says, CAR is the California Association of Realtors. The Fed is normalizing monetary policy, inflation is fading, demographic patterns are stabilizing. That means that the torrent of people leaving California has slowed down to just a relative trickle of people leaving California, and also a soft landing looks more and more likely. These are all good normalizing economic trends. However, pre-existing conditions are still untreated. We still have structural issues to deal with, namely California's supply and demand imbalance. There are far fewer homes than there is demand for homes. New challenges on top of old ones. I don't know what that's talking about. And bonus challenges for RE professionals. We're beginning to get into some of the biased material. And in fact, this whole bottom section, which I think I'm partially blocking, is pretty dumb. I'm going to lean over and show you this one. The golden rule of CA real estate still applies. And what is the golden rule of CA real estate according to the California Association of Realtors? It's that home prices only go up. That's literally what they explain in their slideshow. Guys, home prices do not only go up. In the long run, they tend to always go up, but they do not, in fact, always go up. Moving on. All right, this next slide makes a point that I make a lot. The bond market, not the Fed, matters for mortgage rates. So what are we looking at? This gray line with all this stair-stepping, this is the Fed rate. And you can see it was super, super low in 2022. It came all the way up to here. And just recently, the Fed has lowered the Fed rate by 0.5 point. The yellow line represents the 2-year Treasury yield, and the blue line represents the 10-year Treasury yield. And keep in mind that Treasury yields anticipate what the Fed is going to do. So even while the Fed rate was holding steady, the 10-year Treasury yield went down and went up and went down again. And then when the Fed rate actually dropped, the 10-year Treasury yield went up because the 10-year Treasury yield is responding to what investors anticipate the Fed is going to do. So let that be a huge lesson to you right now. Just because the Fed cuts its rate, that doesn't mean that the 10-year Treasury yield goes down. What I've found in my own economic research is that there are periods where the 10 and 2-year Treasury yield track what is happening with the Fed rate, and then there are periods where they become separated from one another. And the 10-year Treasury yield is acting much more on investor sentiment than it is what the Fed rate's doing. Now, notice this down, up red line in the 10-year Treasury yield. This plays in our next slide. And the volatility of the 10-year Treasury yield over the past 2 years has had a negative effect on the housing market recovery in California. The red line moving through this chart is the average rate on a 30-year fixed-rate mortgage, and these blue lines show the volume of purchase applications. These are people who are applying for a loan to purchase a home. And what we see is when this rate goes down, purchase applications go up. When the rate goes up, purchase applications go down. And this is a very clear trend that we have throughout this chart. So the volatility of the 10-year Treasury yield over the past 2 years has been a headwind in the California housing market getting back to where it was pre-pandemic. This slide shows us where economists think the Fed rate and mortgage rates are headed based on the two most recent Fed meetings, the June meeting and the September meeting. Based on the September Fed meeting, the expectation is that the Fed rate will end last year at 4.4, and in 2025 will come to 3.4 before getting to its 2.9% long-term average. And what's that going to do to mortgage rates? Well, 2024, the average mortgage rate was 6.9%. We expect that to fall to 5.9% in 2025 before landing at a 5.6% long-term average. And it might be upsetting to hear that long-term mortgage rates are going to stay around 5.6%, but that's actually below the long-term average. This graph shows us the average rate for a 30-year fixed-rate mortgage over the past 30 years. That's this red line down the middle. And this red line represents 6.77%. That is the long-term average rate on a 30-year fixed-rate mortgage. And what you'll see is that the periods in time in which we fell below this long-term average were the dot-com bust, the housing collapse, and COVID. Until those significant economic disruptors, rates were well higher than they are now, and now we've been hovering around the very long-term average. So putting a little perspective on life, if we end up at a long-term average moving forward of 5.6%, that is underneath the long-term average we've had looking backwards 30 years. All right, the headline numbers show pretty strong growth for the state of California. On the left here, we have GDP growth with California in blue and the U.S. in red. Generally speaking, for the past 2 years, we've been slightly outperforming the national average. Now we're just slightly underperforming nationally what the GDP is looking like. And California job growth has returned. We've had positive job growth almost every month for the past 2 years. So the economic outlook overall is positive. Looking at jobs, we see that the unemployment rate has actually ticked up in California from a low of 3.8% in 2022 to now we're at 5.3%. Yes, this is a growth in unemployment, but 5.3% is still a very low level for the state of California. We also see that inflation is really subsiding. We peaked at 8.99% year-over-year CPI growth. That's 8.99% inflation, and we are now down to 2.59% year-over-year growth on our way toward the Fed's target of 2%. And these two graphs are super interesting. I've made myself incredibly small so that you can see as much of this page as possible. On the left here, we have aggregate personal income in billions of dollars. And basically what this graph is showing us is that the aggregate income of Americans, that is the collective income of all Americans, has been climbing consistently every year for about a decade. However, on the right, we look at median earnings data, and we can see that the median weekly wage for an American actually peaked right around the pandemic and is lower now than it was then. We can also see that median household income, after growing for a number of years, actually fell in the years since the pandemic and has only now just begun to grow back. So what these two graphs show us is that overall, America's doing a lot better, but at the median, we're kind of struggling. So why are we overall doing so well but struggling at the median? Well, it's because high earners continue to really excel. One area of concern for the U.S. economy and the California economy is the vacancy rate of office buildings. There are just so many office buildings that have such high vacancy that there may be some defaults in that sector which would have an impact in the overall banking environment. It doesn't directly relate to residential housing, but it does affect banks, their ability to loan, and their balance sheets. And as you can see, there are two problem markets in California. The San Francisco market currently has 34.5% of its office space vacant, and Los Angeles, which is the dotted orange line, is at just under 30% vacancy for its office space. Again, this isn't directly connected to the residential housing market, but it is a weight on the banking sector and lending, and economic growth. In this next section of the slide deck, big shocks normalizing, structural issues persist. Let's talk about what that means. So structurally, California just doesn't have enough housing. As you can see, in the 70s and 80s, we built over 2 million units per decade. In the 90s, we built just over 1 million. In the 2000s, when we had the big run-up in housing before the 2008 crash, we built 1.42 million units. Then the 2010s, we built 851,000. In the 2020s, we built 458,000 units. And keep in mind, the population of California is about double here what it was here. This is the structural problem with the California real estate market. Too many people, not enough housing. As a result, housing affordability in California is almost as low as it's ever been. The low point was here in 2006 when housing affordability reached 12%. I think that means that 12% of households can buy a median-priced home. That was a pretty dark moment in California's history. Of course, that was just before the massive crash in 2007 and 2008. And now today, at the end of 2024, California's affordability rate is at 14%, almost as low. So affordability remains a real struggle for California homebuyers. Additionally, obtaining homeowners insurance has become a real challenge in California. Overall, in 2023, 16% of California homebuyers had difficulty obtaining insurance. That number rose to 31% in 2024. And as you can see here, the easiest place to get insurance is when you're downtown or in a city. If you're outside of the city downtown, it's a little harder. Then the suburbs get more difficult than that, then rural areas. And finally, if you're buying a vacation or a second home, it can be pretty difficult to get homeowners insurance. This is a reality of being a homeowner in California right now. My experience personally with my clients, I have so far always been able to get insurance with my clients. Sometimes it takes a little more legwork to find a quote that's acceptable. All right, now I'm going to skip a couple slides because they're kind of realtor BS. This one goes on and on about how meaningful it is to own a home. This one goes on about ADUs. This slide is all about how people are still being born and dying and moving and having divorces. So, of course, people are going to be selling homes. The market still rattles on. This one I think is hilarious. One place we could learn from bond market traders, buy the dip. If your realtor is telling you to buy the dip, don't listen to that realtor. Homes are not securities. Don't buy the dip. Here's a couple slides talking about how good it is to buy a house in California. And lastly, the big question, where does that put housing? Well, the California Association of Realtors expects home sales to grow 10.5% in 2025 to 304,400 units sold for the year. As I said, that's a 10.5% increase over 2024. However, we'll still end up well below the 400,000-ish homes sold annually pre-pandemic. So in terms of the market getting back to normal, we're headed in the right direction, but kind of slowly. And based on Fed meetings, the expectation is that mortgage rates will come down, but slowly, and then flatten out around 5.6%. But as we discussed in an earlier slide, 5.6% is still lower than the long-term mortgage rate average of 6.77%. Plus, home buyers and home sellers acclimate to rates once they become pretty fixed. So once we get the feeling that, look, we're going to be between 5.5 and 6 for the foreseeable future, we'll see a lot more homeowners deciding to let go of their 3.5% rate, sell their home and move on. And we'll also be seeing home buyers who maybe felt sidelined by high rates, accepting that these are no longer high rates, these are just the rates, and stepping into the housing market. And finally, we get to price expectation for 2025. Well, the California Association of Realtors expects the median home price in 2025 to be $909,400 for a median California home. That represents an increase of 4.6% over 2024. And look, every year since the pandemic has been a pretty strange year. I don't think the market is completely normalized yet. I think 2025 will have the shape of a normal market, just as 2023 and 2024, for the most part, had kind of a normal shape of a housing market. But we have a lot of uncertainty headed into this year. We have the insurance nightmare. We have big questions around where mortgage rates are heading. And we have a new administration coming into office in Washington with a lot of plans that are pretty disruptive from the way things are going right now. So what I'm saying is, Stay close to the channel. Subscribe and watch for new videos. I'll be providing California market updates and news about the California housing market every week, all through 2025. See you again soon.